Welcome to BizTech's Wealth Conversation Show. Now, Eastspring Investments Berhad, which is a Prudential company, is one of Malaysia's leading asset management companies. Now, here to give us insights on wealth management and especially the topic of intergenerational wealth transfer is Raymond Tang, Chief Executive Officer of Eastspring Investments Berhad. Now, Raymond, welcome to the show.
Hi, Brian.
Now, Raymond, could you give us an overview of the company and its history?
Thank you. Thanks, Brian, for the questions. Eastspring Investments Berhad is the fund management arm, which is part of the Prudential Group. Now, the Prudential has been in Malaysia for over 100 years. And Prudential Insurance is listed, headquartered in London, and has recently just concentrated its business mainly in Asia. So we are in 13 markets in Asia, so ranging from all the way up north, representation in Tokyo, down south to Indonesia, and the west over to India. So we are in this market serving both not just asset management, but also insurance. In a lot of the markets, we do both. So we manage about $258 billion in US dollars as at the end of last year. The Malaysian office was set up in the year 2000, just initially just offering mutual funds, or what we locally will call unit trust. But now we expanded it to private mandates, what we call. We manage money for institutions, we manage money for these corporates as well. And also unit trust, and totally here in Malaysia, we manage about 57 billion ringgit. I think that's just about 15 billion US dollars.
Now, Raymond, what sort of asset classes do you focus on as part of your portfolio?
I think we started off with the traditional classes, equities, and then we have fixed income, which is bonds. We started out locally, and then we've branched out from Malaysia. We branched out to also regional. We manage money in Asia, and we also manage money, right, through our Singapore offices in other global markets as well. So the other asset classes that we have started looking at is basically derivatives. And also because we are the asset management arm of Prudential, historically we used to manage direct property as well. So, but that is basically have been sidelined for a while. So now we just mainly concentrate on what we call the liquid asset classes, mainly from the point of liquidity and for the point of valuations, so that is transparent in valuations.
And within the Malaysia itself, who are your target customer segments?
In Malaysia alone, we manage a wide spectrum. From one end, we manage all the big institutions, pension funds, and corporates, which are very sophisticated. And the minimum sizes they're talking about is north of 50 million, right? To the other end, where we have customers who are manning the street. And we are reaching out to the next generation. So in that sense, we are talking about their children. So this is we believe in not only investing, getting money for them to invest for them, but also to teach the next generation. Our Prudential and Eastspring has started this program called Money Parenting, right? Where we invite parents to talk to their children about money. It's not an easy subject to talk, you know.
Yes.
So, and we've run a couple of seminars where we invited over 1,000 parents in Malaysia, and to work with a provider to guide the parents how to teach their children about investing, right? And we've done a survey for Prudential that for over 10,000 households across Asia, and we find that the majority believes this is very, very important. About 80%. You know, Asians about savings,
Absolutely.
Savings and education, right? But how they convey to the children, a lot of them find it very awkward because they have no material to fall back on. How deep do they go? But it's very interesting that we went through this exercise that children mimic and mirror the parents. So we went to as young as 3 or 4 years old. We got them in an app, in a clip you can peruse that children would mimic the parents without knowing what they're doing initially. So that is the start. And then we try to teach them about the basic steps of investing. Also, that we have in a more slightly more, how to say it, older crowd. A couple of years ago, we had this program called Springboard, where it's actually a board game. It's what I like to call it is a monopoly on steroids. All right, not just buying properties, buying train stations like in Monopoly, where here we also include where you buy a property, you have a mortgage attached, right? And you can buy unit trusts, you can buy stocks or bonds, and depending on where you land, you get all those cards. The value of your investments either go up or you go down. There's a market crash. So we had that program launched with a lot of schools in Selangor, just to test it out. And a lot of schools were very, very excited to partner with us because it teaches them things which are beyond what is in the national curriculum, and teach them real life. So we had a competition, and the winners of the schools which won and the individuals received unit trust investments from Eastspring as a gift.
Okay,
right?
That's interesting.
So yeah, and the proviso is they cannot redeem it for a year. So we hope to start the trend where I say, look, I want 1,000 ringgit investment for a 16, 17-year-old. That's a lot of money.
Absolutely.
And they will watch how the investment fluctuates over the 1 year. Or maybe they say, hey, I'm making money. By the end of the year, I'm making 6% or 7%. Instead of taking it out, why don't we put more in? So we intend to start a conversation, right? So it is, we are targeting several groups. In Prudential itself, they have this what we call a charging program where they go to schools and actually teach them about money parenting in the local context. So that's where we're reaching out from very high sophisticated corporates down to the man in the street, we buy mutual funds, to the next generation. And we're asking parents, look, you start up a savings account for your child, 10 ringgit a month, 100 ringgit a month. Start it small. It doesn't hurt them. And they get into this habit of savings.
And I think that's a wonderful program, not just a really good program, because financial literacy, especially in Malaysia, has proven to be a big challenge, particularly among the young itself. But I want to zoom in a little bit then on the class that's probably in between. And I'm going to paint a few scenarios for you in terms of wealth. So I want to start with people with the 7 to 8 figure wealth. It's everything from the bakute seller in Klang to SME owners. We want to start with them. And then suddenly some old families who perhaps now have already 9 figures of wealth, and they've gone through, we always think of the old Penang family, the Ipoh family with intergenerational wealth, and it's now at a 9-figure level. But then now we also have old families who have, whose wealth has exploded and have now got into the 10-figure ringgit level. We have listed companies, for example, and these present very different challenges because the first generation views wealth very differently from the second and third generation. Raymond, based on your experience, could you highlight some of those challenges that these families face in terms of managing their wealth?
It's a very good question. I think there are several answers to it. It also depends on, let's say, the amount of wealth for a start and the sophistication and knowledge of the owner or the entrepreneur, we said. On one end of the scale, we have things what we call where the family is educated, their children are educated, gone overseas, and the patriarch of the family realizes that they want to sustain the wealth they have saved. So they started this trend, I think, about 10 years ago. I'm sure you heard of this term called family office.
Yes, which is a huge trend now, especially in Singapore, where family, I think in the last 18 months, almost 300 family offices have been set up.
Yeah, basically family offices are I don't need to engage asset owners. I hire a fund manager to come in and work for my family, right? So, but that will I would say entail also costs. I mean, the fund manager, you invite someone from the market reputable to join them, to set up the infrastructure, it's going to cost a few $1 million a year, right? So, and that means that it's not for those who have 7-figure wealth or 8-figure wealth. You have to be 9 and beyond, right? So, and then they will advise the families on what asset classes, what currencies, hard assets, what you call liquid assets, properties, the whole chain bank, right? So that's one end, one sophisticated end. The mid end, which is that we call the, I would say those who have worked hard, who are sophisticated, but not financially savvy. We're talking about the SME owners, entrepreneurs who built the company from scratch and listed it, and suddenly I'm sitting on 50 million, 60 million. What do I want to do with it, right? So, and for this type of clients, typically this will be the private banking sweet spot. Customers with wealth, but they are not that fully sophisticated in the sense that like the family offices people. So, and they will be selling all sorts of products and all. The challenge would be, I think, for families like this or entrepreneurs, if they're not sophisticated, they may not know the proper asset allocation, the risk profiling of the investments which they're going into, right? I mean that I heard about it a couple of years back where, you know, this term, the accumulator products that were sold in the globally.
Yes.
Right. So when it went out of range, instead of the bank pay them, they have to pay the bank. Quite a number of these individuals, I think, went bankrupt and were suing the banks for misrepresentation. So the accumulator products become accumulator products. Right? That was the term that came out. Right. So I think that's where the danger is. There's a saying in our line: wealth does not equate to financial sophistication.
Absolutely.
Right?
Absolutely.
Yeah.
And especially, I think a lot of times, Raymond, people who are professionals, so whether it's high net worth doctors, for example, who make a lot of money, but may not necessarily be financially sophisticated enough to manage that wealth and perhaps enhance their assets or grow their assets in a way that a professional manager like yourself would probably do.
Yes. And for those doctors, I know a couple, I mean that even the doctors I know personally, a lot of them say, I don't have time, I don't understand. What I'm going to do is just put it in the bank and buy properties. So very similar to the Pakute owner type of approach. In bank and buy properties, what they can see, what they can feel, and then pass on to the next generation. There's nothing wrong with that approach, right? But firstly, you are concentrating your assets in what you call one asset class, and maybe even one geographical location. A lot of them are properties in probably Malaysia. Probably the doctors, we have some properties in apartments in London because that's where they studied.
Yes.
So it's 2 locations, and then you're not diversified, right? It's just hard property, and secondly, it's not liquid. If you have a sudden need of cash in the short term, it's not easy to liquidate. It takes about 3-6 months at the minimum.
Yes.
Or there are other opportunities which arise where you need to liquidate a portfolio. You won't have the kind of I would say turnaround time which will allow you to latch onto other properties. So what I would suggest for people like this is talk to financial advisors. Now, there are a lot of financial advisors around, and depending on what the sophistication level that they require, so that they get the proper advice. Now, I'm going to go a bit beyond just the pure finance. I would think that families like that should consider as one approach of setting up a family trust.
Okay.
Right? where most of the assets, if they want to leave it for the next generation, they put it in the trust. So it can encompass things like all your liquids and all your immovable assets, and it's controlled by a trustee, managed by a trustee, and there are wills properly all made up. Because the last thing that you want, and I went through my own experience 20, 30 years ago when my father passed away, assets were frozen, bank accounts were frozen immediately. Right. So if the patriarch is just the sole account operator of the bank, you can't access the assets. You probably have millions sitting in the bank, but then you can't pay off because the mother, first of all, don't even know which bank the money is at.
Yes.
Right. And we know the process that you need to get the death certificate, get the probate, and go through the courts, and that takes time.
And Raymond, you know what? It happens, unfortunately, and I know cases, it happens a lot today as well. And you would think that they are rather sophisticated people, but no proper wills were left behind and the assets were frozen. And the family was scrambling to get a hold of the assets and meet their needs for that 12 to 24 months that it took to sort out the paperwork.
Yeah. And they may not even find all the assets if the patriarch doesn't, I would say, disclose where all the FD certificates are kept, where all the titles are, you know. And the worst case scenario is the survivors start squabbling over the inheritance because there's no will.
Yes.
Right. And at the end of the day, maybe a part or a large part of the wealth goes to the lawyers. So in order to escape all this unnecessary, I would say it, angst for the next generation, you need to plan, right? And in Asia, thankfully now it's lesser of a stigma to talk about wealth passing to the next generation. 40 years ago, if you try to sell insurance to a Chinaman, he'd probably chase you out of the house with a broom, you know? Why you're trying to capitalize on my demise. But now they understand, I need a life insurance, I need medical insurance, and with COVID, a lot of, I would say, weaknesses in their own thinking are basically exposed, that they don't have enough coverage here, they don't have enough coverage there. So I think that part is well established and it's a growing traction, but it's on passing on, which is becomes you go into the legal framework of passing of wealth. I think that's where a lot of people are not aware that it's not easy. It's not that cookie cutter straightforward.
Now, Raymond, as a wealth manager, how do you help your clients deal with these complexities?
Well, Eastspring is not a financial planner. We don't have trust that a structure that we can offer such services. But if I encounter a client which has these needs, I probably refer them to someone I know who operates such a structure, and maybe I can manage part of the assets, right? Because the client themselves who have assets which I cannot manage. They were properties. I don't have no knowledge of direct properties, right? Yes. So, and if they have businesses, surviving businesses, I would know how to manage it, right? So, but for the client, it all comes in a package. This is my total wealth, of which the liquid wealth, investing in stocks, in bonds for diversification, is part where I can specialize. I can direct them to people like that who can help them to basically relook, take a hard look at their current position and where they need to strengthen the intergenerational passing of wealth.
Now, Raymond, it's been a fascinating conversation, but tell us, what does Eastsprings have in terms of its plans for 2022?
Well, that's a very good question. If I can just go back, I think the catch, the in trend now is what we call climate change, right? You see everywhere. And I was reading in The Edge yesterday, which is a local financial newspaper, that UK is imposing hard deadlines for business to comply with green targets, right? So, and what do we do as a responsible asset owner? Are we part of the problem? Are we part of the solution, or are we indifferent? Right. I believe that the term being used now is, well, this is the only world we live in. Let's take care of it. Right. There's no plan B, you know.
Yes.
Right. So, in a couple of years back, Prudential Plc signed what we call the UNPRI. It's the United Nations supported Principles of Responsible Investing. And it is a big movement where a lot of institutional asset owners which pledge that they will invest responsibly for their investments to ensure to be in the three areas what we call ESG: environmental, social, and governance. In Malaysia locally, Eastspring Investment Berhad is a signatory to the Malaysian Code of Institutional Investors. It is also a Malaysian version of the responsible investing, and we have the huge asset owners who are part of this association to drive the investments, to deliver long-term responsible investment outcomes, right? So I think this is where we want to focus on for the future. And you'll be hearing a lot of terms if you read the media on carbon neutral, carbon zero, right? Wacky weighted average carbon index. So these are all terms which you how to measure the carbon in what we call carbon intensity of your portfolio. If you look at the companies which you invest in, are they carbon generating, which means are they CO2 emitting industries, or are they clean industries? Or a lot of them are in between. They're transitioning from maybe heavy carbon to light carbon to low carbon. So one extreme we were talking about would be the coal-fired power plants, which is, I think, globally it is going to be an investment which is undergoing a lot of scrutiny because they generate a lot of CO2, sulfur dioxide, which cause acid rain, climate change, global warming, all that stuff. So on the other hand, you have power generating companies which use solar, which is very neutral or even positive. But we have to calculate, in order to produce the solar panel, to transport it, to install it, and to maintain it, there is some form of carbon inside.
And so this is the thing, Raymond, that in the ESG movement, now there's a greater scrutiny around that whole calculation of that whole supply chain to get that unit of power out. Yeah. And how sustainable that really is.
Yes. For those who are new to this, that's what we call three scopes. What is called scope 1, scope 2, scope 3. Scope 1 is what you broadly define what you can control, how much I can consume. As a company, I want to change all my lamps from the old tungsten bulb to LED lights. Lower consumption from 40 watts per bulb to 6 or 7 watts. That's easy. And from aircon, I want to maybe upgrade my chillers from the old technology. We use just Freon, which is, I would say, a greenhouse gas emitting, to a non-Freon type. Those are the easy ones. The scope 2 is basically how much you consume. It generally is how much I consume electricity. How can I drive the target lower? And it's a conscious effort not to say that I've changed all the light bulbs in my factory, that's it. But is it enough? Are we going to drive more efficiency out? Right. Scope 3 is the most difficult. Scope 3 is the one where you even compel your suppliers to comply with your targets. Right. But it's quite a difficult conversation to have everywhere. Imagine I going to my paper supplier and ask them, what is your carbon intensity for your output for this ream of paper? He'd probably give me a blank stare. Right. Right. But I think that if more organizations adopt that, it could start a trend. Now, for those companies which are doing the supply chain, a lot of them do not understand what ESG is. Yes. So then ESG means scope 1, I just reduce my power output. But what we have to work with them is because, and the question they always ask is, okay, I buy your story. If I invest 10 million to make all this better, more ESG, how much profits are we going to get out from this investment? They think of it that way. I can't give you an answer because I don't know. But I can say is in the long term, if that is not done, if more companies adopt Scope 3, which means that you will be marginalized out of future tenders.
Exactly, and that's going to impact your business long term.
Yeah, in the long term. That's where it when you say it hits your pocket, then people will start reacting in a quick way, right? But I will never like reacting, which means the lack of planning. So one has to start the conversation to understand and to start making all the baby steps to that direction. Rather, you make a 10 million investment over 10, 15 years, rather than at the end of 15 years, you find that you have to invest maybe 30 million in 1 year.
Yeah.
Right. And then not only the investment, the change in culture of the employees, the way of thinking is more difficult to change a person, right, than to change the system or process.
And change management is always the biggest issue of any adoption, whether it's technology, whether it's in terms of mindsets and stuff. The change is the biggest challenge.
Yes, if you're talking to, like I said, entrepreneurs who build their business from scratch to maybe $100, $200 million business, I don't need this. I have created this. Without all this, why would I need to invest more? But to preserve that and to grow it even further, if you're running a business, this is all important points. Otherwise, the next generation would have reduced value of the investments.
Raymond, it's been a fascinating conversation and I really enjoyed your insights. But before we leave, any final thoughts you'd like to leave us with?
I think that it's a very interesting conversation. I think we're not even touching the surface. We're just glancing at the surface. Absolutely. And there's so multifaceted approach to investments. I mean, we at Eastspring realizes that. That's why we came out with other solutions. We have Islamic solutions through our associate company, Eastspring Awara, which offer Sharia-based combined investing. We also have multi-asset strategies. And for clients, which I just want a return, a consistent return, 5-7% over the long run. And that means diversifying assets, not only in stocks and bonds, across markets, maybe even different alternative assets. So to arrive at the outcome, you probably need a lot of different type of funds to invest in. So that becomes one of the drivers we call Eastspring Portfolio Advisors. So I think that there are a lot of multifaceted approaches to this conversation, but there has to be one that will fit every investor. But remember, as change comes, you may have to change your investment style and approach over time as well. You have to relook at your portfolio, your risk profile again and again to basically know that you are actually taking the appropriate risk. In Malaysia, a lot of times we're not taking enough risk. And once we enter retirement, I don't have sufficient money, right? Absolutely. The pension plan for a lot of Malaysians is my children will look after me.
And that pension plan is not a sustainable or a bankable pension plan always.
Yes. And a lot of changes, that's a separate conversation.
Thanks again, Raymond. It's been a pleasure having you on the show.
Thank you, Brian. Glad to be here.
I'm Brian Fernandez, and we've been speaking to Raymond Tang, the Chief Executive Officer of Eastspring Investments Berhad out of Malaysia on BizTech's Wealth Conversation Show. This video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. Please subscribe and like up to our various platforms. Thanks again for tuning in.